My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. All right, hey guys, I'm Barry Page with Legacy Money. I'm your host. This is the show that shares the truth about money. We're in the studio today. I'm back with my colleague, good friend, and fellow IBC practitioner, John Webster. Hey, John, how you doing today?
Doing great.
Awesome. So in this episode, we're going to cover a question that comes up pretty often, and that is, why should I borrow from my policy? And exactly how to take a policy loan. And we're going to compare the differences between traditional financing and financing using a IBC policy with simple interest versus compounding interest. So before we get started, I just want to remind you to go ahead and subscribe to Legacy Money. You can hit the little bell, and that way you'll be reminded when we come out with new videos. We have new content weekly, and please leave your questions and comments below, and we'll try to answer them in an upcoming episode. So, John, I want to turn things over to you, and you can share your screen so folks can get a look at what you want to share. But we're going to talk again about financing through an IBC type policy. And we're going to let John kind of get into the nuts and bolts of that. So John, take it away.
Cool. The first thing is understanding that by putting your money into the IBC policy, if you're using that money in loans, you're not stopping the ability of your money to maintain compounding growth, tax-free growth while you're taking loans. So that's something that's very hard for people to understand, is you can take a loan collateralized by the value of your policy, and because it's collateralized by the value of your policy still keeps continuing to grow, compound tax-free. That means you're going to get dividends on money whether you take loans or don't take loans. That's a big thing. And that's hard for us to wrap our minds around, because there are very little financial entities that give access to use of money while your money's still working. That's a point of leverage. But what we want to talk about is, on the loan side alone, just on the loan side, how does that loan function, and why is a banking policy loan similar or different? How is it similar or different than traditional lending? Traditional lending uses an amortization schedule. Amortization, the actual definition, amort, that's that's a slow dying, mortality is death. Amortization means a slow dying loan, right? Why is that? Because the bank wants to collect their money and their profit up front. You've noticed that it works really well for the bankers. That's why they've got the biggest buildings in every city in the country, is because they're in the banking business of slow dying loans. And actually, most people, for instance, on mortgages, they never get past that slow dying effect. They pay the front loaded interest, high interest costs, high percentage of payment towards interest, and then they refi and start that process all over again. And they refi about every 5 to 7 years. But I just want to start out with an example, and I want to take a quick look at an amortization schedule calculator. I'm just going to take a simple personal business loan, and I'm going to say that we borrow $50,000, and we do that over a 72-month period, or
6 years. John, before you get into that, you just touched on something that I think we should probably explain a little bit. And because you mentioned on it, the slow dying loans, the 30-year mortgage, people will be familiar with, but they're often, I was just speaking with a client yesterday, that they were going to refi or they were going to purchase a new home with a 15-year mortgage. And so, we've talked, or I have in past episodes about velocity of money, but banks like to turn that money, right? So the more often that they can make loans, the better off they are, because that's how they make their profits, right? Through interest and fees. And though you might have a low loan rate, there's still closing costs, right?
Yep.
So there's a lot of costs that go into that, but I didn't mean to interrupt you. I just want to point out that banks like it when you use a shorter loan amortization schedule. And that's why they give you that schedule, right? So you adhere to their schedule, and that's important.
Yep. Yeah, and that schedule laid out up front, oftentimes if you can get the same interest rate and stretch the loan, you may be in a better position as far as security. You could still make a shorter term size payment and the loan will pay off faster. For instance, you could take a 30-year note and you could make the payment that a 15-year note would have required, and the loan will pay off faster at the same interest rate, right?
There's obviously advantages maybe to doing that, but there's also, you have prepayment penalties, and there's a lot of rules and stipulations put in there by the financial institutions. And I should point out that what you're using here, and of course this is just from, a public site. And you're talking about a business loan, which is hard to come by sometimes. And so these are actually, it says mortgage rate. So people should probably understand. And if you are a business owner, I'm sure you do understand that it's not very easy to come by with a 4.74% business loan. You got to do what? What do you got to do to get that kind of loan?
Well, typically have collateral.
Collateral, which could be your real estate or your business.
Could be your business, yeah.
Could be money in the bank.
Could be equipment that's severely leveraged to back that up.
Yeah, and with the collateral, what do you have to do? Explain that to people. What exactly does collateral mean?
It means that if you were to default on that loan payment, that the bank can come and seize that collateral, auction it off, collect up their money. That means that they could potentially shut down your business, without further notice, because you got a couple months behind on a loan payment.
And so the terms secure loan and non-secure loan, that's basically what they're referring to there.
Correct. And unsecured, the rates might be much higher. Why I chose this rate to calculate off of is because some of our banking policy loan rates are running at 4.4 to 4.74, 5%. So this is right in the middle of those rates, and it gives us a good comparative.
Good.
Showing traditional compared to a banking policy. How those loans operate and function is very different from one another. And so I wanted to do a comparative, show you the differences.
Okay.
So if we calculate that, it's going to give us a amortization schedule. It's going to tell us that the payment every month is going to be at $7.9923 for 72 months. It says that at the end of that period, we're going to have paid interest, and we will pay off that loan balance right there at 72 months. And the first payment, you'll notice, when we send $799 in, the bank collects $198 of that payment in interest costs, and they apply $602 of that payment towards principal. I'm going to go back and redate this loan so that it goes January sequential.
So that interest, and again, I think most people get this, but typically there's more interest on a traditional loan in the beginning, right? You're paying more interest, less principal. So,
Correct.
And towards the end of the schedule, you'll pay more principal and less interest. So the bank collects their portion as soon as possible.
Correct. Yeah, they want to collect, and they're charging interest on a larger balance up front and a smaller balance at the back. So they're charging a higher weight of interest up front because that's against a larger average balance than later on. And the biggest difference that sets apart a banking policy loan from the traditional amortized loan is how the payment is applied each month. And so we'll look at that in comparative. In the banking policy loan, policy collateralized by your value, they are going to charge simple interest calculated, but they're going to apply the payments each month to principal. So that's very different. So I'm going to pull up a sheet that looks at that loan on the right side, amortized, and looks at the loan on the left side, how the traditional banking policy loan applies and pays that loan off. And how it applies the payment is significantly different. You see that, okay, and months 1 through 12, you'll see that on the right, the payment and the interest is just like I was showing. On the left side, this is the banking policy loan. If we make that same payment, $799.23, they're going to apply $799.23 to principal, which reduces this balance on the green column faster than in the blue column. And they're going to, at the end of the year, they're going to calculate what was your average balance, what was your average use of loan funds during the course of the year. They're going to send you an interest bill for the interest tied to that average use of funds. So the average on the left side is $44,805 for the banking policy loan. The average on the right side is $46,031. Why is that? Because the balance didn't reduce as fast during those 12 months worth of payments, right?
So with that loan, is the interest compounding then over time?
Interest is not compounding over time. It is charging the interest based on the average balance over the course of the year. But the average balance reduced faster because our whole payment each month applied towards principal.
Exactly. Okay. So in this example with the bank of the IBC, the loan principal is being reduced every month.
Correct.
Whereas with the traditional financing through the bank, the interest is still compounding?
Yep. The interest is collected each month. It slows down the payoff process. At the end of the year, the interest cost there was $2,211. On the left side, the banking policy, at the same interest rate, 4.74, the banking policy's interest cost for the use of money over the course of the year was $2,124.
Gotcha.
It's not significant. It's not massive difference. It's about 5%, right? But that's significant when it comes to the course that loan takes over time in its total payoff. Now, in the banking policy, they're going to send you an interest statement for the course of the year, and they're going to give you the option of paying that interest 21, 24, or allowing that interest to roll into the balance of the loan at the end of the year and basically push back the loan to 42,000 instead of 40,000, right?
Gotcha.
So it would slow it down. Now you also have the ability to choose the difference. You could have made a $600 payment towards principal, and at the end of the year, apply the difference to pay the interest statement, right? Because you as the banker are completely in charge of this payoff process. You could change your loan schedule in the midst of this loan from a 72-month to an 84-month and
so
recalculate the payment you want to make.
That's a good point. So who determines how much you can make on your payment with an IBC type policy loan?
You as the policy owner are the one in full control of that payment, that scheduling. So when you sit down at the beginning of the loan, you could choose to lay out a payment schedule, and you could say, that payment schedule at $7.99, that seems like a little bit of a stretch. I don't know if I want to do a $7.99 payment. And you could choose to change and say, well, what would it be if I went to a 7-year?
Well, not
it'd be
even
700.
Yeah, and not only that, John. So let's just say your income is irregular, right? Maybe you're
irregular.
A business
Yep.
owner and you have some good months and better months or whatnot, or even in sales of some type. So, if you wanted to make a $200 payment or you wanted to make a $1,000 payment,
yep,
there's no penalty or problem. And as a matter of fact, if you decided, if you were having a good year maybe and you were making $1,000 payments, that would also reduce the interest that would be due at the end of the year. So that interest, we should point out, is due when?
At the end of the policy year, and that's based on the policy anniversary. So it could be, if your policy started June, it would be June to June. And they would send you that statement prior to the anniversary of the policy telling you what the interest charge was for this year.
And so what happens?
And your point, I think your point with the payment is you could be cruising along here with $7.99 and over here with the traditional bank, if you're paying that $7.99 and you skip about 2 payments, what's the bank going to do? They're going to send you a demand letter. If you're the bank policy owner and you skip 2 payments, you know what happens? You don't even get a letter. You simply start paying again at whatever rate and time you want to. You can catch back up. You can pay in advance. You can pay more. You can pay less.
So
you
what happens
if you don't? Control.
If you start repaying that loan, and let's say you go for about 6 months, and then you have a hardship of some kind, and so you don't repay that loan at all the rest of that year, or maybe the next year. What's the insurance company? What happens?
Well, they're gonna apply the interest to the balance, and the balance is gonna then stay the same going forward. Say it's a year down the road, you went from June to June, and here you're gonna have that balance still at 42,000 because you stopped making the payment. Or if you stopped in June, it would be at a balance of about 47,000. But then you could pick up and start making the payments again.
So just to reiterate, with an IBC policy loan, you're in control of the amortization schedule. And if you don't make a payment, you're not going to get hate mail. You're not going to get, versus a traditional loan where you get a demand letter, foreclosure, repossession.
Yeah.
None of that stuff's going to happen. So
Yep.
if you died, if worst case scenario, you died, what would happen? Let's just say in this case, there's a $50,000 loan outstanding, and you had $1 million death benefit. What would happen? And you died.
So that loan is so secure in the eyes of the insurance company because it's collateralized by your cash value that's growing, and it's collateralized by the death benefit of the policy. So if you died, the insurance company is simply going to subtract the loan and the loan interest from the passable death benefit. So if there's a $1 million death benefit, they're going to subtract that $50,000 plus the interest for the time that it was not repaid from the passable death benefit. So it would subtract 50,000 from $1 million,
Right.
and pass on the rest of the death benefit.
And you touched on something, in the beginning that is probably worth kind of coming back to, is the compounding. So even though in that example we were just using, maybe they didn't die, maybe they just either had a hardship, became disabled, something like that, and they did not repay the loan. But the policy itself continues to grow.
Yeah.
So just kind of touch on that again, if you don't mind. What's happening there? Why does the policy continue to grow?
So the policy continues to grow because when you take a loan from the policy, you're not using your money in the loan. You're actually using the reserve of the insurance company. It's one of the ways or means that the insurance company invests their holdings is through loan provision. And so it's a profit center for the insurance company when they make a loan collateralized by cash value that you have in the policy. That's one of the most secure investments. If you went to your bank and you asked them for a loan and you said, and they asked what collateral you would give them, and you told them that you would give them cash as collateral to take a loan, it's a no-brainer for the banker, right? He would go, oh, you're willing to put up $50,000 of cash for us to give you a $50,000 loan? Yeah, we'll do that, right? All day long. Well, the insurance company is doing that same thing. You've got cash value accumulated in your policy, and they're going to give you a loan collateralized by that. They're not loaning you that money, they're collateralizing by that. And that allows your money, the cash value, to continue to earn uninterrupted dividends and compounding while you use the insurance company's money in a loan provision.
Gotcha.
So maintaining growth and compounding means that you're going to get dividends, tax-free growth on your money, and you've got access to utilize the insurance company's money through loan provision elsewhere.
Gotcha.
Now, how many vehicles do you have that you can use your money and make it perform and work in two places at the same time?
Yeah, hard to do that. So you got through year one here, right?
Right.
And this was a 6-year loan?
6 years.
Okay.
So if we carry forward, you'll see that principal payment, and then it carries on and applies. The interest charge at the end of the year, compared to the other side, we're at $30,818 balance compared to $34,883. We get down to year 3. The balance drops to $21,228. Interest charge is at $12.15. Over on the right side, that blue column balance is at $26,771.
Wow.
So we've accelerated by over $5,000, $5,500 on the payoff of the principal balance of the loan.
And that's primarily kind of back to the simple interest versus the compounding interest, right?
Yes. Yeah.
And so with simple, it's basically kind of the reverse on the interest. Is that right?
Correct. So they're charging that interest based on the average balance over the course of the year. And because we're applying 100% of our payment to principal balance, our average balance reduces much faster, right?
So you can pay that loan off quicker.
Making you pay that loan off quicker. Now, you've got the option on that interest payment at the end of each year, pay it or roll it in. Here, we showed it being paid. So that's part of what we're showing in the acceleration of the payoff process, is how we're applying that interest as well.
Right.
But understanding that you've got complete autonomy, flexibility on making the choice of how you want to handle that. And you can make that choice differently each and every year, which over on the right side, the bank doesn't give you that option. And so what we see if we carry forward to month 62 is, if we're making the same size payment, the left banking policy pays off at month 62. That's the same size monthly payment, but we have applied that interest payment, okay? Pays off at month 62. The other is carrying on till 72. So we pay off 10 months early, and then our payments could go back to the insurance company and apply towards PUAs, paid up additions, buying more cash value and buying more death benefit, right?
Right. So this is a hang up for a lot of people, I think sometimes, is if you look at, let's just say year 2024 right here, the 305 interest that was due. Sometimes people don't quite understand that was not a part of the amortization schedule, right? And so it's not the end of the world, if you don't pay that interest, but just understand that the interest is due and it will be charged on the policy, just like the interest, other than it's rolled into the payment with a traditional loan. And so what we're doing now that the loan schedule is paid off is putting that additional money that was going to pay the loan into PUAs, but again, PUA, paid up additional insurance. So it's like reinvesting, if you want to compare it to that, but it's basically buying more insurance, which allows the policy to grow more. Now, let's just say someone, and this, I don't want to get into the weeds too deep and confuse people, but if they did not have any more room in their policy, it was at the MEC limit. And I've covered that again in other videos, but modified endowment contract, there's a limit as to how much you can put over a time period into a policy. But that's where, again, people need to understand, if you want to continue with that payment schedule that you were making, you can always start a new policy as long as you're eligible. You can be underwritten. And that's basically what a PUA is. Just some people may have already been underwritten for the additional PUA, or maybe they stopped paying PUA at some point, so now they have more room to put it. So I know that can be a little confusing sometimes, but that's what you're showing here, is just continuing the payment through the complete amortization schedule, just like in Nelson's book, Becoming Your Own Banker, where he shows that payment continuing to go in. And so it does buy additional insurance, which allows the policy to now grow more and have more access to cash value later on down the road. But if somebody didn't want to make those additional payments, they don't have to, right? If they didn't want to take another loan, there's no obligation.
They're in control. And so, like I like to teach to set up a bill pay schedule with that payment for the amortized time schedule. So if it were a 72-month amortization at 4.74, I'm going to put in and queue in those payments for 72 months. So even when the loan pays off early, it's going to schedule and complete those 72 months worth of payments. The insurance company is going to help us apply that extra money towards paid up additions. and buy more cash value, buy more insurance. And what I also find, though, is that in 72 months, many of our clients find opportunities to take out additional loans as well, right? And
Always
so
something.
sometimes our clients will have 2 or 3 or 4 or 5 loans that they've taken out over a time period, and they're making separate payments on each one, right? Because they're for different uses. They may have calculated different interest on each loan based on what they might get in the market or based on what they want to pay themselves back as far as loan repayment. So the thing is, the insurance company treats all of those loan balances like it's just one loan. So what's that mean? It means that if you've taken out multiple loans in that time period and you get to the end of the one loan, would have repaid off at 62 months instead of 72 months, that additional will just apply to reducing the total loan balance of all the other loans, which means that it's going to accelerate the payoff of the next 2, 3, 4 different loans that you've taken and allow those payments to pay off that much earlier and have that much more to apply towards paid up additions at the end of the loan balance payoff.
Good deal. So there's more money available. It looks like quite a bit more there after that payment schedule, right? You actually paid less interest, but now
Correct.
You're also starting to accumulate. Is that right?
Correct. Yep. So, and that's a good thing in comparing the total interest paid with the amortization was 75.45. The total interest paid along the way with the banking policy was $6,082. But we were paying at the exact same interest rate, right? 4.74%. So why'd that happen? The difference between simple interest and principal applied payments versus an AM schedule from the traditional loan.
Right.
So I want to take it one step further in the calculation, and I just want to show a comparative, because let's say that business owner says, I couldn't go and get an unsecured loan from the bank for my equipment financing at my business for 4.74%. Why would I pay my banking policy back at 4.74%? My bank wanted to charge me 10% for the loan.
Yeah, and that's a great point. I'm glad you're showing this, because
So what would Nelson tell you about being an honest banker?
well, hey, pay yourself back what you'd pay the bank, right?
Yep.
Well, why pay the bank more? And I don't, being a business owner for over 30 years, it's funny how that works. The banks, want to loan you money when you have money, but when you need to borrow money, it's a little tougher to come by. So what do you even got to do? I was trying to get to this earlier. If you go to the bank and you ask for money, and 10% is probably more like it, because they're going to have first of all, they're going to set their amortization schedule. And 72 months could be a little long. I mean, especially some of these new online banking things, the amortization schedule is like 3 years. But they normally, even with a home equity line of credit or anything like that, 10 years maybe, or 5 years is more common, really, right? And then you're going to have tax returns. We haven't even brought up credit scoring, right?
Yep.
So if maybe your business has some debt, or you don't have perfect credit, or even you've got personal debt, how hard is it to get a business loan? Is that an easy thing? I mean, they make it sound like lending has been eased. Can you go to the bank and just get a loan? I mean, what's that like? Do you have to fill out applications? Nelson always called that Mickey Mouse paperwork, right? And you got to qualify, don't you?
Yeah, you've got to qualify. Sometimes you have to have an extra kid just to give to the bank.
Yeah. Right. So with an IBC type policy, you qualify one time, right? You qualify when you
Right.
apply in the beginning. And then once you're underwritten, you're covered, right? So the only thing that matters then is your cash value or equity or collateral, we like to call it, in the policy, right? Because you're going to collateralize what you've capitalized up until that point, right?
Yep.
Okay.
Yep. So
in other words, to make a $50,000 loan, you would have to have $50,000 in cash value, right?
Yep.
And that all depends on how you treat your policy, how you pay the premiums in the beginning. You have to capitalize it. They call it a cap rate with real estate and most things of that nature. So you have to put money in, and that's something, what John is showing you here is just a Google Sheet spreadsheet. So what we try to teach people is to become their own banker, right? You don't get a payment book, right? This is something that you have to manage on your own. Now we're here to help, right? And we can show them and do this for them, but it's about financial independence. It's about controlling this. So if something goes wrong, you're in control of the equation. You can determine what to do. You have options. That's the biggest thing. You've got options on how to pay, when to pay, and what to pay, right?
Yep.
All right, so I didn't mean to interrupt you. So we got 10% is what you're going to show here now versus the 4.74, which I don't know of any business loan, most businesses, if they could borrow money that cheap. And we should point out that the 4.74 just happens to be from one particular carrier today. Those rates today might vary between 4 and 8%. It just depends on the carrier. They're all different. They all have benefits and pluses and minuses. But in this particular case, the company happens to offer a 4.74. Now, we're not necessarily suggesting that rate is going to change that rate all the time. It is a variable rate, we should point out, but it is more consistent. It's not going to jump around like a normal bank rate might, right?
Correct. Yep. Very slow. And most all the insurance companies will only change a loan interest rate once per year, and they'll give you notification if there's going to be any adjustment to that loan interest rate, and then it will carry for another year before there's any possibility of any change.
Yeah, so on the policy anniversary date, we should point out. So that's when the interest is due, and that's when the interest is payable, or else it can be loaned and rolled back into the policy. No Mickey Mouse paperwork, no qualification. The only qualification is the cash value is there.
Correct. So here we're going to look at a 10% loan repayment. Here's the traditional bank at 10%. Their payment's going to be $1,062.35. So if we were going to pay $1,062.35 to them, we're going to come over to our banking policy and pay $1,062.35 over here. That means that our banking policy, the insurance company is going to apply 100% of that payment to principal reduction each and every month during the course of the year. At the end of the year, our balance will have dropped from $50,000 on that loan to $40,409. Okay. And there's something wrong with that math there for some reason in the spreadsheet, but I'm going to carry on with it. The average balance, see what I did? What I did was this time I put the interest back into the balance at the end of the year.
Gotcha.
Right?
Right. So in other words, you did not pay the interest, right?
So the thing is that in this example, our interest that the insurance company is charging on the policy loan is 4.74%. So the interest cost is the same as it was before at 4.74%, it's a little lower because our average balance reduced quicker, so our average is lower, right?
Right. Now, we should point
And
out that with most companies, interest is charged when the loan is made, right? So if you took a $50,000 loan and let's call it 10%, it's 5,000 interest, then immediately you've got a $55,000 balance, right? And then all of those payments, the $1,000 payments, reduce the $50,000 part, not the 5,000. The 5,000 is only due at the end of the year, so it might reduce to say 4,000 if you're making payments, or even 3,000 as the loan reduces, right? So it's charged up front, but it's not due, and so therefore it can actually be reduced, and that's why this is so powerful.
right.
Okay.
So in this example, the loan pays down much more aggressively. Here we are at the end of 24 months. Our balance has it's reduced in half, right?
Yeah.
In half. We're at 24,504. The reality is we get, whereas the other is still got 3/5 of the loan balance due over here.
Mm-hmm.
So when we get down here to month 48, 47, we clear the entirety of the loan balance. When we had it scheduled based on a 60-month payoff process, right? 60-month amortization schedule according to the traditional bank amortization. So we pay off instead in 48 months, and that means that we've got an additional 12 months that can apply towards paid up additions or apply towards accelerating other loan payoff.
Or premium, or wherever you wanted to put the money, versus
Yep.
over there, you still owe 12 grand and you still have, another year or two to go, right?
Yep. So we've got a loan that is completely cleared. That shows that based on that loan payoff, we've got 1,062 of money that's going towards servicing loan every month that is now freed up. That's $13,000 worth of premium dollars that could apply towards funding and capitalizing another banking policy.
Amazing.
Could apply towards maxing our paid up additions in this policy. Could apply towards building more cash value, more paid up additions, more death benefit, and more future usable capital, right?
So let me just kind of, so folks get their arms around this. Just by becoming your own banker, by practicing the infinite banking concept, okay, you're way ahead on having the loan paid off. If you continue the payment schedule like you would have done with a traditional bank, you're going to have an additional almost or $13,000, right?
Right.
Just by becoming your own banker. If you are an honest banker and you repay yourself the same way that you would have paid the bank. Now, we haven't even touched on what's happening with the protection aspect of this, right? If
Right.
something happens to the business, if something happens to the business owner, and again, this could be a personal loan. We're just using the example of business, but it really doesn't matter. Either way, you're going to come out ahead by becoming your own banker.
Correct.
So why wouldn't somebody want to do this, John? What keeps people maybe from looking at this?
I would say the biggest thing that keeps people from looking at it is they don't know that it exists. The other thing that sometimes holds people back from engaging and looking at it is the fear of the unknown. This is something that they've never been taught about. They've never seen before. How could it possibly be true? How could something like this be kept a secret from them? And And that fear of the unknown, without digging in and getting their education, and without digging in and getting their questions answered, that fear of the unknown has a tremendous pressure of holding people back.
Right. Now, what about the person that says, hey, I've got 50 grand, I don't need to borrow money, right? Why would a person that had 50 grand maybe sitting in a traditional bank, right? And
Right.
so they feel like they have cash and they think they're going to save interest, right? So why would they do
Right.
a loan? Why would they want to do that?
Well, there's oftentimes I run into the folks that have been really good with their money and they've saved up, and they tend to think of themselves as cash buyers, and they say, I don't finance anything, I buy cash. I pay for cash for my cars, I pay for cash for my investments, I pay for cash for any major expense, I pay for cash.
Mm-hmm.
And the reality is you finance everything that you buy.
Mm.
And they go, no, I pay cash. And I go, yeah, but when you pay cash, you're giving up the opportunity of that money working for you and doing its job for you forever. That $50,000 you spent will never work and perform and grow and do jobs for you again. It's gone.
It's
And
gone.
when we employ the power of driving it through a banking policy, collateralizing by our banking policy, we maintain control over that banking policy capital to compound and do multiple jobs for us forever. So it built additional death benefit. It multiplied its value in what it will pass on, whether we're here or not. That 50,000 multiplied its value. So a younger person, that multiplication may have multiplied the value of that 50,000 by 4 times or by 6 times. So that means that you employed 50,000 in capital, and you're guaranteeing you're going to pass on 200,000 to your heirs at 4 times multiplier. That's a job that cash in a savings will never do. That's a job
amazing.
that cash spent on a purchase will never do. But it not only does that, it also can be leveraged against that death benefit itself that you just multiplied the value of that 50,000. There can be leverage for long-term care, critical care. There can be leverage towards disability. There can be leverage towards tax-free growth on that money that doesn't ever stop. What does that do over a lifetime?
It's just going to keep growing. And lifetime is a good word, because you brought up earlier that money is gone. Well, people need to understand, not only is it gone when you pay to the bank, right? It's gone forever. Yep. It'll never, ever work again for you or your family, your kids, your grandkids, correct, right? So in this, yep, we're building wealth, but the word you kept using, and I love it, is multiply. You're multiplying, you're taking $1 and having it do the work of many, right? You're multiplying, yep, your efforts. It's almost like having an extra employee that you don't really have to pay. We talked last time about, yep, cost of acquisition, but this is something that, the policy continues to work, it continues to grow, and you have complete access and control over the banking function, which is huge. Yep. So that's awesome.
Big.
That's awesome.
Yep.
Well, look,
big.
We're nearing our time. Do you have anything else that you want to add about this particular schedule or traditional finance?
No, the biggest thing is looking at the interest of the banking policy, the cost of interest in the use of that money, the cost of interest on the traditional bank. That's a significant differential.
Significant.
$10,000 cost of interest difference.
And that's 5 years, right? That was a 60-month?
That was a 60-month loan.
Right. That's amazing. That's amazing.
And then people go, well, I just wouldn't want to pay interest to the life insurance company for using money. I go, well, okay, but why? You know that you, as a policy owner of a mutual insurance company, you're a participant in ownership of the profits that that company makes. They're going to continue to pay you dividends uninterrupted as a profit share while you have a loan or you don't have a loan. But the interest on the use of this money becomes a part of the profit that they're giving you in dividend as a part owner of the mutual insurance company. Right?
That's a great analogy there too. People need to understand that they're taking ownership in the whole process, the whole pool. And if you don't borrow the money as a policy owner, then what's the insurance company, what do they have to do? They have to loan that money out elsewhere. And people should understand that elsewhere means the financial institutions, right? So life
Yep.
insurance companies actually loan money to banks and financial institutions, big real estate projects. So a key point. And so, whether or not people make loans or not, they could definitely benefit. And I just want to maybe kind of close up. I have many clients that have never accessed their policies. They've never taken loans. They've had them for 5-10 years. They literally have hundreds of thousands of dollars in cash value. Can you just give, because I know we're showing a business loan here, but just for the consumer, maybe somebody that wanted to do this and, maybe they were going to use it later to supplement retirement income, or maybe just the death benefit was what was important to them. But what is just maybe 2 or 3 examples to how somebody could get started with a policy loan? I know Nelson uses the car loans in the book, but what's another, just a quick example a family might use their policy for?
Well, there could be big ticket things, events that come along. Oftentimes that could be college funding for kids. It could be a wedding. Do you know of parents that spent money on weddings? And, I went to a wedding this last week, and that's not a cheap event.
No.
I've got 3 daughters.
Yeah, me
right?
too. Yeah.
So I'm on the hook.
Yeah.
It could be weddings. It could be investments. I always tell my clients, if you find opportunities and investments that can make you a much higher return than the interest on your policy loan, use your policy loan to go and take down those investments.
Right.
Why? Because it makes your money make money.
Right.
This is just the first parking place to redistribute the working capital that you've accumulated to go and find other opportunities to make your money make money. Right.
And I think one thing too, maybe a smaller example, I'll just point out a couple. My first policy, my first loan was to pay property taxes, right? Now, you were speaking of big ticket items, college, weddings, things of that nature. I had all of a sudden, because our rental properties had, we did not escrow. We had our equity in the homes. So we chose to take the insurance and taxes out. Well, lo and behold, that first time we did that, I had a $50,000 tax bill due. Now, fortunately, I had the cash value in my policies that I could pay that bill that was now due. But just for a normal family that maybe only has the house that they live in, and maybe that property tax is $1,500, $2,000, $3,000, $5,000, whatever it might be, it's a smaller loan, right? So they could certainly use this and pay themselves back or pay the policy back that way versus paying that. And something like church, charity, maybe you tithe, whatever that amount is. And, or maybe your auto insurance, you pay monthly. People don't always understand, and again, we're not PNC agents, but, PNC companies charge interest on that money. So if you pay monthly, you're going to pay more than if you paid annually. So what if you could just pay your auto insurance or your homeowner's insurance annually and then repay that to the policy loan, right? And have your money working harder that way. So just a couple things that people, get them to thinking about how they could have their money work harder.
Yep.
Awesome. Well, anything you want to close on? Any last comments, John?
I think just get your questions answered, dig in, understand how to make your money make money.
Absolutely. Well, thanks so much for joining us today. Thank you, John, for sharing that with us. That's very enlightening. And again, we want to teach you how to create financial independence. So if this is something that you're interested in, all of my and John information will be in the show notes. If we can help you in any way, please leave your questions and comments in the comment section below. And join us next time in our next video. We'll see you on Legacy Money. Have a great day. Thank you for joining us.
Thank you.